Let me start with a simple story. A couple in their mid-30s bought their first home in 2021. Nothing crazy, just a normal suburban house. 3 bedrooms, small backyard, decent neighborhood. At the time, mortgage rates were around 3%. Their monthly payment felt manageable, around $2,100 a month. It felt like they had made a smart financial decision. Everyone around them was saying the same thing. Real estate only goes up. Fast forward to 2026. Their family has grown. They now have 2 kids, and they want a slightly bigger home. Nothing luxurious, just something with an extra room. So they call a real estate agent and list their house. Weeks go by. No serious buyers. The few people who do visit the house seem interested, but none of them make an offer. Eventually, one couple tells them the truth. We love the house, but the monthly payment would be too high. That moment captures exactly what's happening across America right now. The U.S. housing market hasn't just slowed down. In many places, it feels like it has completely frozen. Homes are sitting longer, buyers are hesitating, sellers are confused, and the strange part is, prices didn't suddenly collapse like in 2008. Instead, the entire system feels stuck. To understand why, we need to rewind a few years. Back during the pandemic, money became incredibly cheap. The Federal Reserve dropped interest rates to almost zero to keep the economy moving. For millions of Americans, that translated into something powerful: extremely low mortgage rates. People were getting 30-year mortgages close to 3%. That might not sound like a big difference at first, but in housing, interest rates change everything. A family that could only afford a $350,000 home suddenly qualified for a $500,000 home. Monthly payments looked reasonable, so buyers stretched their budgets. Demand exploded. People rushed into the housing market out of fear they might miss their chance forever. Prices climbed at a speed the country hadn't seen in decades. Neighbors started comparing home values. People watched their house gain $100,000 or even $200,000 in value within a couple of years. It felt like free wealth. But then something changed. Inflation began rising everywhere. Groceries got expensive. Gas prices climbed. Rent increased. Life started costing more across the board. To fight inflation, the Federal Reserve had to reverse course. Interest rates started climbing rapidly, and mortgage rates followed. Within a short time, those 3% mortgage rates disappeared. Suddenly, buyers were looking at rates closer to 6% or even higher. That might not seem dramatic until you look at the monthly payment. Take a $500,000 home. At a 3% mortgage, the monthly payment might be around $2,100. At 6.5%, that same house could cost well over $3,200 per month. Same house, same price. But now it costs more than $1,000 extra every single month. For many families, that difference makes the house completely unaffordable. And that's where buyers started pulling back. People still want homes. They still dream about owning property, but the math stopped working. Now, here's where the story takes an unexpected turn. Normally, when buyers disappear, prices drop quickly. But that hasn't really happened in most places. And the reason is something economists now call the mortgage lock-in effect. Think about the millions of Americans who bought homes between 2020 and 2022. Most of them locked in mortgage rates between 2.5% and 3%. Those rates are incredibly valuable now. If those homeowners sell their house today, they lose that rate forever. Imagine going from a $2,100 payment to a $3,500 payment just to move into a similar house. Most people simply refuse to do it. So instead of selling, they stay. They delay moving. They renovate instead of upgrading. They adapt their lives around the house they already own, which means fewer homes are entering the market. So now we have a strange situation. Buyers can't afford homes because rates are too high. Sellers don't want to sell because their mortgage is too cheap. The market ends up stuck in the middle. Not booming, not crashing, just frozen. And when housing slows down, the effects ripple through the entire economy. Construction slows. Furniture sales drop. Renovation projects get delayed. Local businesses feel the shift. Housing isn't just about real estate. It touches almost every part of the economy. But there's also a psychological shift happening. For years, people believed housing prices only moved in one direction, up. That belief drove urgency. Buy now before prices go higher. But when uncertainty enters the market, people behave differently. Buyers become cautious, investors step back. People start asking a different question. What if prices stop rising? Right now, no one knows exactly how this will play out. If inflation cools and interest rates eventually fall, mortgage rates could drop again. That would bring buyers back and slowly unlock the market. But if rates stay high longer than expected, housing may remain stuck for years. Instead of a dramatic crash, we might see something quieter, prices slowly adjusting, homes taking longer to sell. A market that moves much slower than what Americans got used to during the pandemic years. One thing, however, is very clear. The housing boom from a few years ago was not normal. It was powered by historically cheap money. Now that money isn't cheap anymore, and the housing market is learning how to live in that new reality. For millions of Americans thinking about buying, selling, or investing in real estate, this shift could define the next decade. Because what changed in the housing market isn't just prices, it's the rules of the game.